Tuesday, September 12th, 2017, Monaco64 here. Looking at the UK government and how it's shortchanging, or if you want to call it like it is, screwing the public with its statistics, and also with the way it's working with the Bank of England to manipulate interest rates and keep them almost at zero or, near 1%. And why am I making this video? Well, today we had UK data came out at 9:30 a.m. London. That's usually when the statistics come out, and they're so-called inflation data, CPI, and that's what the public and the government looks at, the consumer price index. It came out at 2.9% year on year. It was expected 2.8. Month on month, it was also higher than expected, 0.6 and 0.5. But there's also a number that the government doesn't consider statistics anymore, and it's called the RPI, the Retail Price Index. And it's slightly different than the CPI, but it's the statistic that used to be used by the government for payments, for pay increases by employers as well. They would give their workers a pay rise, if the RPI or inflation was running at a certain level. But since 1997, with when the Labour government came to power, they stopped using that RPI. But the RPI runs a lot higher. So today the RPI came out at 3.9%, basically 4% year on year. It was up 0.7 for the month of August. Even the core RPI, which probably excludes food and energy, that came out at 4.1%. And why did I say in the beginning of the video that the government is screwing the public? Well, because they base a lot of the, state pensions, public sector workers' salary. It's all based on the CPI, which is average, usually, it's most of the time lower than the RPI. So first of all, I'm going to read a little bit here from a website, statslife.org.uk. There's a little article about RPI versus CPI. What's the difference? Why does it matter? Will it make you poorer or richer? And it goes on to say, the Office for National Statistics, ONS, is topping the headlines in all the UK media today. Well, and this is from January 2013. It doesn't always happen. Why? The ONS has surprised almost everyone by recommending that the government sticks to measuring inflation by the RPI rather than changing to the CPI. Headline grabbing? Oddly, yes. Here's what it's all about. And in case you didn't know, RPI is the Retail Price Index, CPI is Consumer Price Index. So why does it matter? Lots of payments are linked to inflation. Pensions, benefits, index-linked savings. The higher the inflation rate, the higher the payments. RPI almost always gives a higher figure for inflation than CPI does. The decision will cost the Treasury and private pension funds billions in higher payments it will have to make. So basically, the UK now uses the CPI. And the other thing that we see, the main difference, I'll read you the main difference. Basically, the CPI does not include mortgage interest costs, rents, or council tax, which everyone pays. So in the last 8-9 years, rents have gone up a lot, council tax have always gone up. Mortgage interest costs, maybe not so much, but with mortgages getting bigger, even though rates are quite low, they still have gone up. So historically, the CPI is about 1% lower than the RPI. It doesn't seem much, but like right now, it's over 1%. It's about, 1.2%. And it's not surprising that you're seeing headlines in the UK right now. One of them is from the Independent. It says, union leaders threaten to strike over public sector pay cap. And just to let you know, I'm not defending unions or the government or anyone. I'm just giving you the facts. But it says here, union leaders have raised the threat of strike action over the cap on public sector pay, accusing ministers of cherry-picking certain workers for wage increases. Reports suggest police and prison officers could be in line for a pay rise above the 1% limit after the government signaled it would lift the long-standing cap for specific public sector staff. So, you know, most of the public sector workers are getting only a 1% rise a year, while, you know, the cost of living, the real cost of living, which includes housing, you know, everyone has to have a house. Most everyone has a mortgage, or a lot of people rent. That's going up by 4%. So by getting a 1% pay rise, you're actually getting a pay cut of 3%. And that also doesn't include, you know, the private sector, because the private sector, you know, they'll say, oh, you know, we're going to raise your salary by, you know, 1.5%, because that's what the CPI was last year, even though the RPI is running at 4%. So, yeah, so it's not surprising you're getting a lot of dissatisfaction from the public sector workers. And then, you know, you can see how governments and politicians always protect themselves, because this was from, let's see, December 2013. And that was just when they started, before they decided to drop RPI from everything. It says MPs pay politicians to get 11% pay rise. So it says the Parliamentary Standards Watchdog defies party leaders to announce an 11% rise, but says it will not cost public a penny more. So, you know, for this pay increase of 11% came into effect from 2015. So MPs get 11%, but, you know, the people in the bottom and the general public, they get 1% or less. And then there's another one here from 2016. So, yeah, sorry, from February 2017. So this is after getting an 11% pay rise, just about 2 years before. They're going to get another pay rise, and it's 1.3%. The MPs, that's from, it says in the Mirror, MPs to pocket another bumper pay rise, busting their own public sector pay cap. And they're getting 1.3%. So everyone else is getting 1%. And they got 11% as well before. So, you know, the other thing that I wanted to talk about is, you know, about interest rates. You know, like the base rate in the UK is basically at 0. The gilt yield, the last I checked, is, you know, the 10-year gilt is around 1%. You know, and that's being, you know, kept there artificially by the Bank of England, and, you know, by them printing money. You know, it's you know, and it's not surprising that the pound is continuing to lose value. A lot of people say it's because of Brexit, but that's complete rubbish. You know, right now, for example, let's have a look at the UK rates. The 2-year gilt, 0.23%. 5-year, 0.49. 10-year, 1.07. So you have, you know, like the currency being debased by 4%, probably even more, because I would argue that even the RPI is fudged compared to probably the way it was calculated 25 years ago, a lot like the US CPI. So here you have, you know, the true definition of financial repression. It's when the government and the central bank in cahoots manipulate things and tinkered with statistics and screw everyone. But will you learn that in schools and universities, in the economics department? I doubt it. And I'm not a socialist. I'm just being fair. I'm not defending anyone, you know, public sector workers or anything. I'm just talking about the fairness within the system. So normally, for example, if our GDP growth is about 1.5 or 2%, and you add inflation of 4%, you know, that's like 5.5 to 6. The interest rate on the 10-year gilt should at least cover for that, you know, for the GDP growth plus the inflation. So, you know, the 10-year gilt should be around 6.5 to 7%. But no, it's at 1.07%. And who's suffering from this? Well, people, savers are suffering from this. And the other people, that's, you know, and the biggest spendthrift in the UK, of course, is the government. With the huge deficits it's been running, and the deficits become accumulated debt. We've got, you know, debt to GDP, if you include the debt that we took to save the banks in 2008, that's even over 100% of GDP. So that's what's happening. You know, the UK public is being bamboozled, and it might sound innocuous, the difference between RPI and CPI, but that's the way they do it. Plus, you know, the banking system working together with the government, because can you imagine if, you know, interest rates should be at least 4%, you know, to at least protect the currency against the 4%, you know, debasement we're getting or inflation that we're getting every year. But no, it's at 0. So, but the thing is, if they start raising interest rates, the whole banking system collapses. The government can't borrow, and if they can't borrow, they can't pay their old debts, and it just becomes like the 1970s when the UK had to call in the IMF to bail them out. So, am I saying this is just a UK problem? No, everywhere in the West. The reason I've done this is because I live here, and you know, that's what interests me a bit more. So if you enjoyed this video, please like, share, subscribe to my channel if you haven't yet, and you can follow me also on steemit.com and on Twitter. And I'll talk to you later. Bye.